From the morning reading, the stock indices pull back on lighter volume following record highs. The VIX drops. Breadth weakened compared to the prior session as decliners led 2203 to 805 on the New York Stock Exchange and led 1948 to 837 on the NASDAQ. Get me in. Traders rush into some of the most liquid ETFs Wednesday, triggering a spike in assets in the Spiders, Qs, and IWM. For the S&P 500 fund, SPY, it was the largest inflow since 2014 and since 2015 when expressed as a percentage of total assets. When traders saw fit to rush into the fund to such a degree, it has caused assets to rise 3% when it was at a 52-week high. Future returns, though, were weak. Financials erased part of Wednesday's jump. The main financial ETF, XLF, erased the gains it made during regular trading hours from Wednesday. The few other times it gapped up to a 52-week high, then erased its regular hour gains the next day, it tended to see further selling pressure over the next 1 to 2 weeks. Snap made its debut. The IPO of Snap was made possible by a welcoming market. In 2014, we looked at how industry indices tended to perform after a large IPO, which was not good and proved to be so again that time. That doesn't look like a great sign for the communication stocks right now. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:28 a.m. Mountain Time, and I'm recording this in preparation for the market day, March the 3rd, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, we're seeing just a bit of weakness, but nothing of significance across all four of the U.S. broad-based indices. They're all down just below scratch. And crude oil up just above scratch, euro up about 0.5%. Long bonds down just below scratch, and gold down about 0.4%. And overseas action, we failed to update that chart, so don't pay any attention to that. In terms of macroeconomic reports for today of note for the United States, you have the ISM non-manufacturing PMI, and you also have FOMC member Evans speaking, and then later FOMC member Powell speaking, and then followed there by Fed Chair Yellen speaking, along with FOMC member Fisher. So a lot of Fed members speaking today in the middle of the trading day. So just be aware that could have some cross currents coming from that. Now, normally we would have the non-farm payroll report today, the big monthly report. That has been moved back by 1 week, so that will actually be on Friday, March the 10th instead of today. So be aware of that. In terms of current volatility conditions, short-term VIX 9.60, so still exceptionally low. Skew still in a warning stage at 133.4. IV percentiles have dropped some from recent sessions. The S&P at a 15, the Russell a 19, the NASDAQ a 7, and the Dow a 26. We did have standard deviation size moves put in on two of the markets yesterday. The S&P and the Russell had -1 standard deviation size moves. With the Russell, you'll note that we've had the pattern the last 4 days with pretty fair amount of volatility. You've had two -1 standard deviation days that were interspersed between a +2 standard deviation day and a 1 standard deviation day. So a lot of ripping back and forth on the Russell, ultimately not to really get anywhere, but a lot of noise in the middle. Let's go ahead and take a look at those charts. So on our S&P, you see the big horizontal breakout that we had midweek, and then yesterday was a bit of a dark cloud cover. That does mark for a bit of a reversal pattern. And after a big day like that, frankly, it's not surprising. It's really, from a probability standpoint, almost expected that you have some retracement. Retracement so far today looks to be relatively weak. And really nothing of significance has happened thus far in last night's overnight into this morning's action. Same pattern on the Dow. Big horizontal breakout followed by, in this case, I suppose that's a bearish harami. And it's actually up a little bit at the time we're looking at this chart. And the NASDAQ also broke out. And then also filled a little bit of a bearish harami, I suppose. And then a bit more weakness, but still higher than where the start of this move began midweek. And here's the more interesting one of late, just because lots of movement just to pretty much end up right back where it was. If you go back to the close of 224, we're basically the same place as we were, and then yet we had, big up day, big down day, big up day, big down day, and then today, well, guess what? We're right back where we started with on the open of 224, and all that other stuff is just kind of noise going back and forth. In other markets, crude oil had a bit of a breakdown yesterday, but it was still within the context of the trading range. We're still very much nestled within that area. Gold's had a bit of a move of late. Some folks are arguing that the dollar's correction is over for 2017 and we'll see a resumption of the dollar's up move. And if that happens, you'll likely see the safe haven status of gold start to lose some of its polish. And indeed, gold does seem to be at a bit of a move to the downside. Now, within the context of the intermediate term, we're still trying to make some sense as to, has this been truly a trend break, and we're getting higher highs and higher lows. We even got above the Ichimoku cloud, and, everything seems to be hunky-dory for gold to be in a longer bullish trend, and yet at the same time, within the context of everything, we've seen some big gold overshoots. Here was one here where, you think you're in a big bullish trend, you get a big counter trend move, and then just a prior resumption. So what is this right here? Is this just a big counter trend move and then we get a resumption to the downside? If you look at the dollar and you listen to the folks that are talking about the dollar lately, that's exactly what they would argue, that this was just a big counter trend move and that the dollar is getting ready to move higher. And if it takes out these highs, certainly we'll probably see gold taking out those recent lows. And then bonds. Bonds also has been playing. We've been watching to see whether this channel bottom, this triangle bottom, would mean anything. And it does not seem to mean anything at this point. In fact, we'll go ahead and remove that. And the question now is this horizontal area of support of any meaning? And it's not a super strong horizontal support at this point. You do have some support here, and it seems like we've respected that in the last couple sessions a little bit, but it's not something that seems to be a super strong area. Not a lot of touches or anything like that. That the bonds would break down and come down here to the 147 handle would not be a bit surprising. So we're waiting to see just where bonds get with this move. But there does seem to be a probability bias to the downside on bonds. And then finally, let's take a look at the volatility. Volatility, again, is very low. We're still below a 12. So historically very low, and most of this stuff is just noise when you're just trying to trade in those very low areas of volatility. So no real changes there from our recent conversations. Let's go ahead and go over to the daily report. And market trend intermediate term phase opinion, still market phase 4. This is an extension pattern that is bullish. And the 3 market timing signals, a couple subtle changes. The first signal from IBD, confirmed uptrend, that's bullish. GMI index, still bullish, but has eased a bit. We're down to a 5 out of 6 and a 6 out of 8 on the GMI2. Still, overall, though, that is bullish, and that buy signal is intact, and it's been in place since 11:10. Stock charts decision point scoreboard. We now have almost the perfect stack. Short-term, intermediate-term, and long-term all are bullish, with the lone one signal exception on the long-term NASDAQ. Position sizing opinions still both at 100%. Intermediate-term market postures, all exceptionally strong bulls across all 4 indices, and that's further supported by the strong bull sentiment line. So one of the things to keep in mind, we seem to be experiencing just a little bit of weakness in the broad market as we digest this recent big move post Trump's address to Congress. And any kind of pullback would be expected from a probability standpoint because of the strong bull sentiment line to be relatively mild. So kind of keep that in mind. In terms of the hedge warning status, we're still 0+, normal with some elevated conditions, and frankly, it's about as minimal on the elevated conditions as it can get without us going all the way out to a level 0, perfectly normal bull market kind of status. So this is getting to be a fairly benign risk level of late. Strategy opinions, we have had this VIX bouncing back and forth. It's back below a 12 right now. So we'll just kind of put a caveat to this. You know, we've had this as within the acceptable range to initiate. We were above a 12 for a few days. Frankly, in the bigger picture, we've been bouncing back and forth between above 12 and below 12. So it's not ideal conditions for new positions in the option income strategies for novice traders due to those low premiums that you get when the VIX is that low relative to the amount of risk that you put on. So just kind of keep that in mind. Cover call strategy, still the same defensive structure there. When you're in these market phase 4 extension patterns, you want to be a little bit more conservative. Put selling, any kind of pullback like what we might be experiencing right now might be giving you some setups to be able to sell some puts or put spreads, and that's preferable, put spreads, against some of those positions that you might be willing to hold. Remember to keep those position sizes in the scale that you're willing to own. In terms of specific areas of warning, it really is pretty low. You have the low VIX, which that's a warning in itself because you expect at some point volatility to expand, though it can stay low for pronounced amounts of time. You also have a true warning here, and the skew is a bit elevated. So kind of keep that in mind as well. Under the trend area, everything there looks fine. Under the intermarket risk aversion indicators, we have 4 as risk on, 1 as risk off. Frankly, these we'll call this neutral at this point. These continue to be very, very horizontal on the indicators, very much wrapped around each other. Not a lot of separation or angle on those. Sentiment. Stock's intermediate term is up to an 8, and the fear and greed index is into the extreme greed category at this point. So kind of keep that in mind. So these in and of themselves are not necessarily warnings. They're mostly just alerts to say, hey, when we are in high sentiment, extreme conditions, that we look for those signs and symptoms of exhaustion and reversal patterns, but we can remain in these extreme areas for pronounced periods of time. From a sector specific, yesterday was a bit of a, we're kind of a retracement consolidation day, and as you would expect, the defensives did well. Utilities, consumer staples, telecom, all positive for the day and all with good breadth. Well, that's your defensive sectors, whereas those more risk-on areas like financials, materials, industrials, all those risk on areas. Here's tech down 2/3. They were all quite negative and with very negative breadth in each of those sectors. In terms of market posture, we continue to see transportation, telecom, and energy. And I would also throw in there retail. Retail just barely went up, but it seems to be one of the first to go negative when we have some negativity in the broad market. So those are your sectors that seem to be less strong in their postures across multiple time frames more consistently of late. In terms of performance, you see utilities here. If you look at this 3-month performance, if this is a big time, healthy, strong bull market, then we should be led across these different time frames by the risk on sectors. And right now, frankly, here we go. We have utilities at almost 12% on the 3-month time frame. But also look at this. They're one of the leaders in the 1-month time frame, and they're the leader in the 1-week rolling time frame, and then of course yesterday. So that's not the signs of a healthy risk on, taking lots of special opportunities to go after those those sectors like technology and so forth. Now, I will say technology has had good performance in the 1-month and 3-month, but seems to be kind of gathering itself at the very least of late. And then, of course, energy, a lot of red across the different time frames in energy. So not a lot of progress being made by investors within that sector, unless you're maybe selling. So a couple things to keep in mind. The financials performance, big surge out the gate after the post-election period, but as we get further and further away from that post-election period, some of these results are starting to moderate. Though the 1-year period certainly is quite healthy. Well, I think that's probably enough for today. Let's go ahead and wrap this thing up. And we'll hit the various slides here. If you see something of interest, just hit the pause button. Get your details. Hyperlinks take you to greater details. And disclosures, as always. Hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for Monday with our next market preview. In the meantime, manage that risk profile and you'll get that consistency going in your trading and investing. Good trading.